really happy that we do a duo presentation here with Goldman Sachs. We have Hugh Lawson up very early in the morning because he is joining us live from New York. And Thomas here, also from Goldman Sachs, running the floor here in Denmark, in Copenhagen. And Goldman Sachs is here to talk about ESG readiness in this new regulatory landscape. We've heard quite a bit on ESG, but now we will get yet another angle to the topic. So welcome to both of you.
Thank you, Helen, and thank you for the introduction. Is Hugh on the line, or can you hear us, Hugh?
I'm here, Thomas. Good morning.
Good morning, sir. We are so happy that you're on the line, otherwise we'd be in big trouble here. But welcome to Copenhagen, Hugh, and I will turn up to the first slide, I hope.
Wonderful.
No? Here you go.
Okay.
Here you go.
Thank you. Well, good afternoon, everyone. I'm very sorry. I was hoping to be with you all in person, but I'm delighted that Thomas is there with you. I signed on a little bit earlier, and I think I was listening to the presentation by our colleague from ATP. It sounded very, very enthusiastic. The only words that I could understand were greenwashing and sustainable things. It seemed very exciting, so I hope Thomas and I can do a similar job. Well, let me just start with a little bit of a context, and some of this data I'm sure is quite familiar to everyone in the audience. ESG asset flows have been very, very strong year to date. So if you look at the typical databases that measure client activity, through the summer, net flows into, and this is in liquid markets, active and passive strategies, so think of funds and ETFs, that were recognized as ESG strategies. And that spanned the full spectrum of integrated strategies, thematic strategies, but basically any equity or fixed income strategy that was recognized as an ESG strategy in some way had net inflows of something like $100 billion of capital. Strategies that were not recognized as ESG integrated in some way had outflows of around negative $150 billion. So really quite an extraordinary acceleration of client interest and capital interest in ESG strategies. That's obviously gotten a lot of press attention. What's going on, and I hope today we can unpack a little bit of that. An interesting point also in terms of investment performance, if you take a look at it, in the aggregate, ESG funds, as well as stocks that have a high ESG rating, have tended to outperform. And that also has gotten quite a lot of press. Is that simply because there was a factor loading on technology or on growth? What's going on? Actually, I'll say in our work, much of that performance actually in the active strategies has been down to security selection. So it's very interesting to see that it's not just simply a tilt in a sector or a style, but there really is some important advantages to security selection with a heightened ESG awareness. So that's very good news. Thomas, if you wouldn't mind to go to the next page. So as a backdrop for these flows, there's been a tremendous amount of activity among corporates around the world around their own ESG profiles as operating businesses. All of that, I'm sure, is quite familiar to the audience as well. But what's interesting here is many of these organizations have concluded it's in their interest and their obligation to make larger and larger investments to advance sustainability around their operations. And you see a lot of innovation in the space, corporates partnering with supply chain partners to try to get to net zero, both in the direct operations and more indirectly. You see some corporates really pushing the frontier of climate tech and really bulking up their corporate VC activities to help stimulate innovation there. You even see things, that we call co-opetition, where normally competitors in the space who may have a common need as part of their business model will work together to solve it. You've seen it, for example, in packaging areas. So sustainable packaging is of common interest to retailers, and there's been collaborative investment around that. Very, very good. I mean, the flows are so strong, and we see this as so central to corporate strategy that last year, Goldman Sachs itself, we announced we have a $750 billion target to help facilitate flows into sustainable finance, where we want to put our financial innovation behind our corporate and investing clients and what they want to do. So those trends are a little bit of the backdrop corporately, and so it links to the flows that we saw earlier. Now on the next page, however, I would say, and I think part of the rationale for this presentation is that the industry is at a crossroads. Again, much of this will be familiar to you. There's a cacophony of vocabulary around what ESG means. We have the challenge around inconsistent and incomplete data. We have definitions that are varied. It's very hard to measure. And importantly, we're seeing a trend around a very, very different regulatory approach emerging. I'm sure what's being discussed at the conference in terms of the role that the EU taxonomy is going to play, particularly next year. That's one approach. In the United States, there's been a different approach. And what I would say is there's a much, much deeper issue there about your predicate around how you think about markets. How efficient are they? How forward-looking are they? What inefficiencies and structural challenges are there, and what's the obligation to help undo those? But what I would say is we're in a period where I think there has been a fundamental change. The first thing is operating businesses feel an obligation to think a little bit longer term and more carefully about the impacts that their businesses have, both directly and indirectly. Many of their customers are expecting it, broader stakeholders are expecting it, and it becomes central to corporate strategy, as you see. Different regulators around the world are encouraging that, which again leads to a virtuous cycle. And if you link the first two pages where you see the strong asset flows into strategies that are self-consciously ESG-centric, and you see corporate announcements around it, hopefully there's a virtuous cycle taking effect, where ultimately the cost of capital perhaps may be a little bit more beneficial for companies that are much more clear about their sustainability and ESG policies, which in turn enables them greater financial wherewithal to continue to invest in that. And so I think one of the things that investors are noting is ultimately how that's all going to play out. So in terms of complexity, the next thing that I would say, and we're sort of focusing on the next page, Thomas, with the question, is what does all this mean? So this phase of flows, corporate activity, investor awareness has been very, very positive. But in most asset allocation and portfolio construction, the methodologies by which that's done are largely unchanged. Most of the methodologies are informed by CAPM. Most of the methodologies use risk premium assumptions around market cap or issuance-based indices in the case of fixed income. And so asset allocation for most asset owners is driven in a similar manner to the way it was 10, maybe 20, perhaps even longer years ago. And so ESG today, in most cases, is a question of an implementation choice. So you've set your asset allocation, then ultimately you have to make a choice about how you implement that asset allocation. You have equity exposures, you may have a range of capitalizations, you have a range of fixed income and so forth. ESG becomes a question of style or implementation underneath. The real aspiration that I think the market does have and should have is ultimately, can ESG be at a level of a factor that could influence asset allocation at the top level? We have a lot of ongoing research where we're thinking about those issues, others in the market do. And ultimately, I think if there were a rigorous breakthrough in that manner, that would open the floodgates even further in terms of flows and really raise ESG factors as a fundamental basis for allocation. And so I'm hopeful in the next couple of years we will do that. So the complexity of the context really is about, if I summarize, three things. One is we have the data and definitional challenge, which we're coalescing towards hopefully a set of standards over time and best practices. Secondly, you have a regulatory complexity where two large regions of the world, the divergence is accelerating. That's interesting to see. It makes it complicated for both asset managers and asset owners a little bit in terms of how they think about their portfolios. And then thirdly, the ultimate goal really is to have at the level of asset allocation a structure and a framework where ESG is at the same level as the fundamental factors that drive most people's allocations. I would say that's the agenda really for 2021. So that's a quick tour of public markets. Now, what about private markets? What do we see there, and how do these issues play out in that space? So why don't I turn it back to you, Thomas, to maybe share your thoughts with the audience on that topic.
Thank you. Yeah, and I think there's a good sort of segue into the private market. And I believe if we had this conference 3 years ago, we were asked, should we look at ESG into private markets? At that time, very few ESG eligible assets, very few investors had an ESG framework, and the allocation to alternatives was so small that was a very small risk to the total portfolio, so why bother? And here, sort of 2 or 3 years on, the average allocation to alternatives in Denmark among institutional investors are 25-27%. We see the flow into ESG eligible private market funds and assets, as we saw before, increasing yearly by double digits. We have private equity firms under the UN PRI definition of 2.15 trillion. So it's definitely an area that have growing, an area that matters, and where the risk is actually substantial. Also, when we look at impact fund, last year the capital raise to impact fund was around 28 billion compared to 8 billion just some years back. So why not implement ESG in alternatives and in private markets? I think many do. ATP and Bofod gave a very good example how to integrate and how to sort of move the needle. We'll come back to the approach that we also think is eligible, which is very alike, by the way, to implement it. But there's hurdles. Data has been mentioned. How do we actually measure it? ESG KPIs within private markets is evolving to say it the least. And it requires some specialism that we'll come back to. On the other hand, it gives us a lot of opportunities. You have the full ESG spectrum within private markets, across alignment, ESG implementation, and impact. And we combined, just look at the public market and think about how difficult it is to have a consistent framework across traditional asset classes. Then it's even more difficult to have it in private market. And then on top of that, could you have a consistent evaluation of ESG across all asset classes? We think it's very difficult and therefore very important to have a consistent investment framework, realizing it cannot be very difficult to be consistent and asset class by asset class. So here's just showing the sort of a distribution of risk and opportunities. As ATP and Bo also mentioned, we see a lot of opportunities in this spectrum, going from the left tail risk, and also remembering ESG is much more just than risk management. It's much more than just exclusions. But of course, that's where sort of the alignment starts. Do we see any climate transition risk, heating, flooding, that will affect the portfolio? Any supply chain transparency, sectors that you didn't thought you have exposure to pops up, etc. And then in the middle of the distribution, you will have your ESG integration. You can refine your processes. You can work with the companies. You can optimize. And on the right tail opportunity set, the impact. And I think having a framework that's consistent, there's too many moving parts going on to do it at once, as we also saw before, but break it into sub-components and exclude well, and then optimize the middle of distribution, and then potentially go into the impact route as well. The difficult thing is not to point out the topics. I'm sure this is the 8th slide that you see today that is alike. this is the easy part. The themes are very sort of recognizable, is very sort of mainstream, but we are sort of cautious, and we have seen several times that it could be a ESG trap. We see that you pick the right theme, but you invest wrongly. And it is to sort of how do you then capture that opportunity set that are there? How do you measure and participate in the mega trend that is going on in the world in a consistent way where you're highlighting risk, where you're measuring risk, and you have a consistent framework. And we see it among institutional investors globally. Some years back, it was basically, I like the asset, I participate in that fund or direct investments. When I get the asset in, I strip away the financial risk that I don't like. It could be inflation, it could be country risk, etc. But I basically took the full package. And today it's much more upfront. The negotiations are sort of pre-deal transactions, negotiations. How can this asset be aligned with the framework that the investor has? And we very much support that approach. Again, how do we then find the right opportunity set? How do you find the right opportunity set, the right manager, the right asset? And this is just a very simple way of how we are assessing it in our impact fund, for example. Going from the standard approach, was it here? No. It's going from the standard approach, here we go, to an advanced approach just to do the normal sort of due diligence questionnaire. It needs to be extended, it needs to be thoroughly iterated, you need to have a sort of good score on all the points. You need to follow up. And also, I think the slide I like the most with ATP and both was actually transition between investment departments, boards, and implementation. And we see it over and over again. We had a recent example where we did due diligence on 2 funds in a particular industry, an area that we find attractive. Both looked appealing in terms of risk and return. And Fund 1 had the head of ESG, had the nice slides, had a sort of a framework. But when we moved further across and spoke to the senior investors, so how you impacted by your ESG framework? And the answer was, no, not really. We excluded a few companies, but no, I do basically what I used to do. And then we compared to another company, similar industry, that did not have a clear ESG policy. So kind of low score in the beginning. But when we went to the investment professionals and went through the processes, it was actually very thoroughly ESG, but there was no head of ESG, there was no slides, there was no sort of official framework. So just sort of an anecdote that, ESG is many things. Yes, there's opportunities set on the right side of distribution, but it requires a lot of specialism to actually gain and participate and be part of the impact opportunity set, is our experience so far. So this was just a very sort of brief approach to how we look at private markets. Of course, a lot of details, a lot of specialists are involved in different phases. But I think the key message from us is you can play the full spectrum in ESG within private markets. There's a lot of opportunities, execute well, and of course, either build up a department on your own or work with an advisor is at least our experience. I think with that, I will bring it back to you, and basically sort of you, if you can comment across both private market, public markets, and elaborate on that part.
So Thomas, I think those were excellent points. And on the last slide where we see the themes that we're most focused on that are investable, I think I'd make a few observations about best practice. First of all, I think it's the slide before, if it's possible to go back, I don't know. Thank you. First of all, I think we're wary of labels. So we prefer less labeling and more actions speaking for themselves. So as our investors in private markets think about places to put capital, they organize the research and the ways in which they do it along the sectors that you see here. We think these spaces are interesting and investable. They ultimately have an important impact, but what's driving the investment thesis is ultimately why these sectors are attractive, their need for capital, and the kind of returns that are possible if executed well. The second thing, and I think, Thomas, it's a very, very good point, in terms of the amount of capital that can be absorbed prudently varies a great deal. And so one of the challenges large asset owners are facing is if they have to deploy substantial private dollars annually to meet their targets. If you look at the sectors on this page, clean energy, for example, can absorb quite a lot of capital prudently. Other segments have a hard time doing that. Certain things, for example, in digital health, they can absorb capital, but not nearly to the quantity where clean energy is. And so if you're focused on building a program, we encourage our clients to think about building a beachhead in the sectors that make sense, and ultimately over time, you should be able to scale across them, but it won't be even. And so what I think in terms of behavior is asset allocators are having to make smaller allocations, smaller individual investment allocations than they might normally, but they would, in essence, want to place in the queue. Third thing I would observe, and Thomas, I think it's a very good point about the manager anecdote, where, you know, when we engaged with them, there was nothing labeled about them ESG or impact, but quite squarely what they were doing was exactly that. I think the most effective active models that we see in both public and private markets are where ESG is truly integrated into the financial decision making. I think if you see an organization that has a clear separation between one type of investors and ESG research, and they aren't really intertwined in making decisions together, I think the market has moved on way beyond that, and that's no longer best practice. So with that, I don't, Thomas, if you have any final observations, or happy to take questions from our colleagues.
I think you hand it over to Helle and go to the Q&A.
Yeah. We don't have any on them. No? Thank you. So do we have any questions from, yes, from you in the corner?
I think today we've heard some really interesting challenges that we have to tackle with data, different types of approaches and dilemmas. What I really like about your presentation is you talk about evaluating competences in investment funds. And I think what I'd be curious to hear is what your thoughts are on what the type of competences are going to be that we need to evaluate investments, products that will really make a difference here in this space. And we've heard quite a bit today also in the other presentations that it's not the sort of thing that we learned when we studied finance in our textbooks, right? So it's something we're going to have to learn as we go along.
Thank you. Could you hear the question, Hugh?
I could.
Will you pick it up? Thank you.
Would you like me to answer it?
Yes, please.
Well, you know, it's interesting about the competences. So on the one hand, I agree that it's a little bit different than what we might have learned in finance 20 or 25 years ago. Although fundamentally, some of this is much older than that. I mean, I think if we had asked a different generation 50, 60, 70 years ago, whether you were a public market investor or a private market investor, such as it was then, you know, did you actually understand what the businesses that you were investing in were doing? Did you think about the consequences of their actions and how that might be perceived? You know, what about all of the things that each business is required to execute? I mean, their customer preferences, the way in which they attract and retain talent, and so forth. Obviously, it was a different time and a different era, but those questions would not be off the mark. I think what's happened is the rise of passive investing, which has lots of beneficial effects. It clarified things, it certainly lowered costs for people, but it went a bit too far in the sense that it allowed allocators of capital and abdication of any responsibility for actually understanding, you know, to whom they were providing capital. And so I think the basic shift of, you know, even if you implement passively, you should understand, or somebody on your behalf should understand what these businesses are doing, and if there's some important room for improvement there, that in some way or another that could be made clear. And so I would say the basic impulse behind this is quite old. So in terms of competencies, I think we all have to become a little bit like management consultants. So when you think about what's best practice in a given industry as it relates to, say, supply chain management or labor, or what's a realistic decarbonization plan for a given company or given industry, what technology may be relevant, how to do it. I mean, those are much more operationally intensive questions, not purely financial questions. And so I would say the skills that need to be assembled, either by yourself or with partners, are both the financial skills that we all know about, but also a much more operating awareness of the kinds of industries that you're investing in, and what's a realistic path to execution. So unfortunately, I think what this does is or fortunately as the case may be, makes investing a bit more work than it's been maybe in the past couple decades.
You happy? That's good. Do we have any other questions from the audience here? No? Would you come up and have a question? Marie-Louise.
Question for you. I don't know if it's Thomas or Hugh that is going to answer this, but what would be your primary advice for the market, a market the size of Denmark? Is there an opportunity to grow a green market here in the Nordics, and could it lead flow away from London?
Or New York?
Yeah, definitely from New York. I'm going to let Thomas answer that question.
Yeah, thank you. But definitely so. I think there's opportunities on both sides. Both on the investor side, I think that's where at the moment we are differentiating the most compared to a global setting. The Nordic Danish investors are very advanced in ESG, as we heard today, in the implementation, and we definitely see it ahead of the broader investment community globally. On the consumer side also, I see a very strong view. I see a strong consumer demand that will affect the corporates. And on corporates, I don't have a strong view, but I would say it's more in line. I see it more in the investor side. Danish investor community are advanced, investing both domestically and abroad for the opportunities, than seeing Danish corporates ahead of global corporates. Please.
I think we need to.
Okay, well, I can. So interesting.
We could ask you many more questions, but I'm looking at the time and all sorts of signs. So, or do we have one more from the audience? Okay, sorry. One last question from the audience.
Thank you for an interesting presentation. Bo mentioned that 25% of the inflow of investments right now is sort of green. Isn't there a limit to what is available out there? What kind of ratio is a limit for green investments? I mean, there's not a limited number of windmills and solar cells and whatever.
Well, Thomas, maybe I'll jump in quickly. I would say I'm not sure that phenomenon is really different than any other scarcity matter around investing. I mean, there's a limit to the amount of capital that all sorts of phenomena can absorb, and I'm not sure that thoughtful investing, where you're advancing, if it's a green investment, a climate agenda is any different. What I would say also is that markets obviously are not static. So, hopefully there'll be positive economic growth globally. That will require capital for that to happen, and industries adapt. And so, the phenomenon that we talked about at the beginning, if there really can be a cost of capital advantage for businesses that make the case that their sustainability footprint is at the leading edge, then ultimately other businesses will follow, right? And so you may have an opportunity for your capital or whoever's capital is at issue to help nudge these businesses along, and then that ultimately in itself creates places for capital to go. So I think with all investing, you have to think about the rules of economics. There's valuation questions, there's capacity questions, there's execution risk and limited management bandwidth, no doubt. But hopefully we're in a period where the cycle is relatively virtuous, and so more and more of this is evolving.
Any additional comments from you, Thomas?
No,
or
thank you.
You're happy?
Yes.
Good.